Hello, iBond fans. So, the new annualized iBond rate for all iBonds issued between May 1st, 2023 and October 31st, 2023 is 4.30%, which includes a higher than expected fixed rate of 0.9%. What does this mean for both short-term and long-term iBond investors? That's what I'll be covering in today's video. 1. How this new annualized iBond rate of 4.30% is calculated. 2. What your new rate will be depending on when you bought your iBonds. 3. A quick recap of when I would redeem if I were a short-term iBond investor. 4. How the higher than expected fixed rate changes our 2023 iBond plan as long-term iBond investors. And 5. Who might consider redeeming 0% fixed rate iBonds to grab this new fixed rate. First things first, thanks to all of you who reached out on Friday, April 28th with the news that Treasury Direct had already posted this rate. Because to the best of my knowledge, it has never been posted before May 1st, the actual iBond rate reset date. Some of you even wanted to know if this was an error or fake news, given that Treasury Direct system apparently crashed briefly shortly thereafter. Well, my assumption is that it's neither an error nor fake news, given that at the time of this taping, before Monday, May 1st, this page is still up there. The new fixed rate and the new inflation rate are also up. But it seems the new composite rates, which combine the fixed and inflation rates, are not updated yet. Those will probably only go up on May 1st. And quite frankly, it does make sense that Treasury Direct posted this new rate on Friday, April 28th, because that is the rate you would have gotten had you purchased an iBond on Treasury Direct on Friday, April 28th, since orders are only processed the next business day. Perhaps Treasury Direct is also becoming a bit more precise given all the limelight that iBonds received in 2022. So here's how this new annualized iBond rate is calculated. A new fixed rate of 0.90%, higher than I had expected. But who doesn't love positive surprises, right? Especially these days, and in particular if you're a long-term iBond investor. Because remember, this fixed rate stays the same for the entire 30-year term of an iBond, meaning that no matter what inflation will be in the future, you'll always be staying 0.90% ahead of inflation. Now, as I always say, this won't make you rich. That's not what iBonds are designed for. That's what the stock market and your other investments are for. But the 0.90% fixed rate is certainly welcoming news for those of us who are using iBonds to inflation-proof a part of our longer-term portfolio and or as an inflation-protected emergency fund. And just so you know, the 0.90% fixed rate is the highest in nearly 15 years since the 0.70% fixed rate that was announced on November 1st, 2008. So we have the new fixed rate of 0.90% plus the new semi-annual inflation rate of 1.69% times 2 because the iBond rate is quoted on an annualized basis. That gives us this 3.38% here. Plus the new semi-annual inflation rate adjustment of 1.69% on the new fixed rate of 0.90%, what I lovingly refer to on this channel as the bump. Because, well, it is a little bump. That's this 0.02% here. Add all this up, and here's the new annualized iBond rate for all iBonds issued between May 1st, 2023 and October 31st, 2023. And for those of you who've asked, while the fixed rate stays the same for the 30-year term of an iBond, this semi-annual inflation rate does change every May and November, as does the bump if your fixed rate is more than 0%, meaning that your annualized iBond rate also changes every 6 months from the date of purchase. If you're new to iBonds, check out this iBond interest video here, which I've linked in the description below, for the detailed iBond interest formula that we dissected last year for the super savers on this channel, as well as how iBond interest works in general. And here's a table of the must-know iBond basics. If you already knew all of that, thanks for your patience, and let's move on now to the next section of interesting numbers. Here's what the new annualized I-bond rate means for existing I-bond holders. This row shows when your I-bonds were issued, when you bought them basically. This row shows the annualized I-bond rate at the time of issuance. This row shows the fixed rate at the time of issuance. This row shows the new semi-annual inflation rate of 1.69% times 2 to get to an annualized number. This row shows the new semi-annual inflation rate adjustment on the fixed rate, the bump. And this row shows your new annualized I-bond rate based on the May I-bond rate reset. So, if your I-bonds were issued between November 1st, 2021 and April 30th, 2022, here's the rate you'll be getting after 18 months of holding your I-bonds. If your I-bonds were issued between May 1st, 2022 and October 31st, 2022, here's the rate you'll be getting after 12 months of holding your I-bonds. And if you bought your I-bonds between November 1st, 2022 and April 30th, 2023, here's the rate you'll be getting after 6 months of holding your I-bonds. And do keep in mind that because these are annualized rates, you'll need to divide them by 2 to figure out what your actual earnings are over the given 6-month period. Right. So what now? As I mentioned in this recent I-bond redemption video, which I've also linked in the description below, personally, if I were a short-term investor who has not held my I-bonds for at least 5 years yet, and I'm thinking about when to redeem my I-bonds in order to earn a higher yield elsewhere, I'd redeem any I-bonds originally issued at the 7.12% rate after month 21, and any I-bonds originally issued at 9.62% after month 15. This means that what I would end up losing as my early withdrawal penalty is 3 months of this new lower annualized I-bond rate here, rather than 3 months of the higher annualized I-bond rate from the previous 6-month holding period of 6.48%. Because at the time of this taping, I'm not aware of anything that, all things being equal, is as safe and stable as an I-bond that's paying an annualized rate better than 6.48%. If, on the other hand, you've held your I-bonds for more than 5 years and the early withdrawal penalty no longer applies to you, then it may make sense to redeem your I-bonds when this new semi-annual inflation rate is applicable to your composite, your combined annualized I-bond rate. Because there are CDs as well as T-bills at various maturities offering better rates right now. Of course, this will depend on a number of factors, including your fixed rate, financial goals, tax rate, just to name a few. Everyone's financial journey is different, and you'll need to base your I-bond redemption decision on your own personal preferences and circumstances. Now, if your I-bonds were issued here at this rate, you won't be able to redeem them until you hit the 1-year minimum holding period anyway. And if you do redeem your I-bonds in month 13 and have to pay this early withdrawal penalty, here's what your ending balance with early withdrawal penalty would look like, assuming an initial investment of $10,000. Still not a bad return depending on where you live, considering that you only need to pay federal income taxes on I-bond interest earned and not state and local income taxes. Now, let's talk briefly about some tweaks we'll be making to our personal I-bond strategy for the rest of the year. As many of the I-bond fans on this channel already know, our 2023 I-bond plan had been to buy half of our annual $10,000 limit in April and the other half sometime in October, because until a few days ago, no one knew exactly what the May 1st fixed rate would be. And we did end up buying half in April, and we still plan on buying the other half before the end of October. By doing so, though, we'll have maxed out our 2023 I-bond limit for this calendar year after we make our purchase in October. And the initial thinking in mid-April was that we would then be done for this year. Given the new 0.9% fixed rate for all I-bonds issued between May 1st and October 31st, though, depending on interest rates, inflation rates, and how much additional emergency savings we may have by the end of October, there's a chance we'll be gifting one another some more I-bonds to take advantage of the current I-bond fixed rate. And I've heard from some of the super savers in the community that this is something they're also contemplating. So for you long-term I-bond investors who've maxed out your I-bond limit for 2023 already, but who still want to grab the 0.9% fixed rate, gifting remains an option. Be sure to check out our I-bond gifting 101 video first though, if you're a bit fuzzy on how this works exactly. If you're currently holding 0% fixed rate I-bonds for at least 1 year, you haven't maxed out your annual I-bond limit for this calendar year, and you want to take advantage of the 0.9% fixed rate, but you don't want to put additional new money into I-bonds, you're someone who might consider redeeming those 0% fixed rate I-bonds to grab the new fixed rate. Keep these 3 considerations in mind though if you do go down this route. 1. If you've held your I-bonds for less than 5 years, the new I-bond fixed rate of 0.9% that you'll be getting, it will make up in a little bit less than 1 year for the early withdrawal penalty of 3 months interest at this new lower inflation rate. So if it were me, I'd hold for 3 months at this new lower inflation rate and then redeem, so basically keeping the higher interest rate for its full maximum duration and minimizing the 3 months of early withdrawal penalty. 2, you'll need to pay federal income taxes on all interest earned when you redeem your old I-bond to buy the new one. So make sure you set some cash aside if you don't want to be hit with a surprise come tax time. This, of course, assumes you've chosen the default option of paying I-bond taxes upon redemption and not annually. 3, the clock starts ticking again from the very beginning when you buy the new 0.9% fixed rate I-bond, meaning you'll have to hold your new I-bond for at least a year before redeeming all or part of it. And you'll need to pay the early withdrawal penalty of the last 3 months' interest if you decide to redeem your new I-bond between years 1 and 5. If you've thought through all these implications and whatever other factors may be relevant to your specific circumstances, then redeeming 0% fixed rate I-bonds to grab the new higher fixed rate as a long-term investor may be something to consider. An additional note for those of you who are long or at least longer term investors whose goal is just inflation protection and not necessarily building out an inflation protected emergency fund like us, it may make sense for you to look into the I-bond's slightly more complex sister, TIPS, Treasury Inflation Protected Securities. Because the real yield on TIPS, what's essentially the fixed rate equivalent for an I-bond, it's higher than the new I-bond fixed rate of 0.90% at the time of this taping. Here's what it looks like for a 5-year TIPS, and here's what it looks like for a 10-year TIPS. As I mentioned, TIPS are a bit more complex than I-bonds and do not work as well for those of us who are building out an inflation-protected emergency fund. For more details and to see which might work better for your situation though, check out this video here on the pros and cons of I-bonds versus TIPS. So it's your turn for an update. What's your 2023 I-bond plan given the new 0.9% fixed rate? Redeem, gift or buy more, or redeem to buy more? And for those of you redeeming, where are you putting that cash into next? Drop a comment below and let the community know. All right, Super Saver, I hope this I-bond video was helpful. And as always, if you enjoyed this video and learned something new, don't forget to share with those you care about. And of course, hit that thumbs up and see you again very soon with another brand new wealth building video.